Hello, my fellow investors. I have here a short analysis on gold resource, symbol GORO. And there's actually a pretty funny story behind why I decided to analyze this company. A short while ago, I made a video on Warren Buffett and Charlie Munger's view on gold versus Marie Eveillard, who was a great French value investor. And he claims that even value investors should hold at least 10% in gold. He says there's all kinds of risks in the world. People don't think it's so big of a risk. And that's his perspective. And I don't like miners because they're not good businesses, as Warren Buffett says. But I think everyone would agree that we're living in unprecedented times. And no matter what your side of politics are, we're not in normal times. I think that's pretty obvious. So I was thinking maybe it would be interesting to look into gold companies. Now the thing is, gold companies are totally out of my circle of competence. I have no idea how to value them. I don't understand gold, so I dismissed it. I didn't think it was for me. But then, as a funny thing happened, someone who's very close to me, he called me up. He said, "Listen, this gold company just went crashing down. This is a gold resource. You can see here, it went down from $1.63 to $1.15, and now it's trading at 88 cents." And he told me, "Could you please check it out? What's going on? Why did it go down?" And okay, I said, "Let me check it." I just checked in a few numbers. I called it back. I told him, "Listen, I see here a few problems. I have no idea what's going on behind." But then I said to myself, maybe it would be a good time to actually try to analyze this company deeper. So that's the story behind why I decided to analyze this company. But I have to say it's out of my circle of competence. So because it's out of my circle of competence, I'm going to view this whole company from a net investor, a Graham kind of investment, not a Buffett kind of investment. I don't know how to analyze the future income. So I'm only going to analyze the assets and a few other things. So what's Gold Resource? So this is their website. They have mainly one operating mine in Mexico. So I'll just read a few over here from their website. Gold Resource Corporation is a mining company that pursues gold and silver projects that are expected to achieve both low operating costs and high return on capitals. GRC has a consolidated 100% interest in 6 properties in the southern state of Oaxaca, Mexico. The company's Oaxaca properties were selected based on their potential to meet the company's whatever. GRC currently controls over 684 square kilometers, including 55 kilometers of geological important structures, fault corridor, whatever. The company's flagship operation is the Oguila, however you pronounce it, Oguila project, a part of a Don David Gold Mexico, with Arist undergrounds, whatever. So they have one operating gold mine in Mexico already. The first year that they actually started selling was 2010. So it's already over 12 years that they're already mining from there. They started much before that, but since 2010 they're actually selling silver, gold, whatever. And the company additional 4 exploration properties are all within trucking distance of the Aquila project processing facilities. GRC objective is to ultimately have multiple properties feeding ore to the strategically located mill, which aims to potentially reduce the capital required to put any future deposit discovered into production. So the main project is not even fully explored yet. So that's one thing. Now, another thing is they bought, in the end of 2010, they bought the Back 40 project, which is in Michigan, USA. So another thing I think is important is anyone who is looking to buy gold as a risk protection, not as a value investment so much, I think something should be taken into consideration is where the mines are. So if let's say you hold 10 gold companies and all their mines are in the same country, and so if anything happens in that country, so basically all the investment is in a risk. I think it is anyone who's getting into gold for the sole purpose of protection against any crazy things that might happen in the world. I think it'll be a smart move to diversify into companies that have mines all over the world. I think that is a smart move. Well, again, this is out of my circle of competence. So what's a Back 40 project? Back 40 project, when developed, is expected to produce gold and silver doré and copper, lead and zinc concentrates bearing gold and silver. The current feasibility studies planned to be complete in the second half of 2022, with permitting followed. So they plan to finish the study in the second half of 2022, and then it starts the process of getting a permit. And then the company could start exploring, and as you can show later on, they believe in 2026 they'll be starting to always the Back 40 project, if everything goes good, in 2026 will be operational. So this is the story of gold resource. Now, as I said, this is out of my circle of competence, so I'm basically going to try to figure out what's the book value of the company. And this over here I got as a little bit tricky. So this is the last 10Q. You can see they have 199 million in assets and 83 in liabilities, which is 115 for shareholder equity. Divided to around 88 million shares, it comes at about $1.30 book value per share. Trading at 88 cents. So we could say, okay, it's trading at pretty much on the book value. Okay, so as mining companies are out of my circle of competence, one of my first questions I wanted to ask myself is a gold mining company trading on the book value a bargain? Who said it's a bargain at all? So what I did was, I just made a screener, and I wanted to know how many companies, gold mining companies, are trading on the book value. So what I did was like this. I went into the descriptor, I just put in gold. Only industry gold, nothing else. It gave me 45 companies. And if I'll do trading under a price to book value of 1, so it's 17. 17 out of 45. If I do any, though, it brings me up 45 companies. Price book value under 1, 17. So 17 out of 45, that's almost a little bit more than a quarter of the companies. So that doesn't mean that gold research is a big bargain. If it's trading under book value of 1 and they have a quarter of the companies under book value of 1, it's not such a big bargain. So I tried to check out a few of them. So the Canadian companies that have a problem with that, I don't know how to check them out, how to read their annual reports. But what we could do is like this. So out of these 17 companies, so if we take, let's say, SSRM, I actually checked just a little bit, and it looks also pretty interesting. And there should be also a shout out to them. But let's say if we take this company, Paramount Gold, I don't know, it's 14 million in market capital. It looks like a junior company. The bigger companies, let's say KGC, that's a big company, 4.5 billion in market capital. That if it's trading on the book value, that's not just a junior company. Well, a lot of these small companies, $11 million, $30 million, they might just be junior companies that they even started to do any production. So that's not such a big question if they're trading on the book value. But CDE, that's an old company in silver and gold mining. So if it's trading on the book value, okay, that's one. We have here Gold Resources, another one. So it doesn't seem to be such a rare occasion for a gold mining company to trade on the book value. But on the other hand, it doesn't mean it's not a bad investment. Okay, so before we get into analyzing the balance sheet, it's pretty dumb to analyze the balance sheet without checking the earnings. So I put in all the numbers in my spreadsheet. So the company started selling in 2010. Their annual reports are since 2006. In 2010, they still lost money. The net revenue was a minus of $23 million. But 2011, that was the biggest year. They earned $58 million. And the margins are pretty high, 55%. And from then on, just went down 22%. But you can see every single year since 2011, which is the first year the bottom line was positive. They were earning $33 million, $85,000 nothing. $15 million, $3 million, $4 million, $4 million, $9 million, $5 million, $4 million, $8 million. And this is the most recent quarter. They lost money, and I guess that's why the stock went crashing. So technically, the only year they lost money since 2010 was 2020 in COVID. So the total operating revenue was a minus $758,000. The reason the bottom line is positive is only because they got tax benefits. But technically, in 2020, they lost money. And you can even see another thing, that their net operating cash flow is a lot higher than their net revenue. So over here, let's say $8 million in revenue is 34, $4 million and 21, $5 million and 21, $9 million and 22, $4 million and 35. But the problem is, mining companies, in their essence, are a bad business because they have an asset, and the whole time they're depleting the asset, and they need to use the money that they're earning from the sales to buy new assets. If not, they'll be out of business. And you can see that the free cash flows are way lower. The capital expenditures are very, very high. But so at least we got one thing. The net revenue every single year, technically besides 2020 and the last quarter, the last year, were positive. And the operating cash flow every single year, even in 2020, were all positive. But the free cash flows, that's if you take off the capital expenditures, so that almost every year they're earning money. Well, now you have here $60,000, $6 million, $17 million, $28 million over here in 2019. Again, that's COVID. More or less, they're earning money pretty good. But now, another great thing about this company, when we're dealing with a net company that's trading under book value, is they have no debt, and they never had debt. So over here, they had some kind of loan. It's nothing, $1 million, $2 million, but they never had any debt. And that's also a very good thing. If you don't have debt and you're not paying interest, even in these years that they had this interesting kind of loan, they didn't pay interest. So that's a great thing also. So basically, here, this one, I'm not going to analyze the earnings report. I just wanted to check out if there's anything bad going on in the past 10 years. So let's get to the last, most recent quarter. So this is the numbers for the last 10Q. And revenue 23 million, gross margins already minus, and the total operating revenue was a minus of $9 million. And so these numbers are for the last quarter. And for some reason in their cash flow statements, they didn't put for the last quarter, but only for the last 9 months. So these numbers are for the last quarter, and these numbers are for the last 9 months. So the operating cash flow for the last 9 months was $7 million, almost $8 million, and their free cash flow was minus $6 million. So more or less, we're getting a view of a company that in the past 12 years was earning great up until COVID. Now, in the end of 2021, so they purchased a new mine, which is meanwhile only costing them tons of money, and they're not gaining anything from it. So people see a company that's only losing money, and it's not actually losing money, as it seems to be. It's just because they're investing in the future, so the numbers are bad. So now we have to start analyzing how good is the balance sheet. Okay, so let's start analyzing the balance sheet. So the first thing that jumped out to me right away when I opened up the last 10K, this is from 2021, is this amazing dilution of the shares. It's over here in 2020, they had 74 million shares, and in 2021, 88 million shares. That's a dilution of almost 20% in a single year. And so this said right away, you can't buy a net if every single year you're losing 20% of the value. So I went to backtrack all the shares outstanding since 2006. And this is what I got. And this wasn't looking so good. So here in 2006, they had 28 million shares. And each year they're diluting it, we could say, at a pretty high rate. And in the last year, until 2022, 75 million shares. So from 28 to 75 in a span of 16 years, that's a dilution of how much? Of 6% or something like that? And that's not a fine number. If the company is earning 10% a year, its growth is 10% a year, so that means the shareholders are earning only 4% a year, which is not good at all. But if you want to be more fair, we should really start looking since 2011 and not since 2006, because in 2006, it was still a junior company. It was only just exploring. They didn't have any sales yet. 2010 was the first year they started selling, but they still lost money. So let's just take from 2011, they had 56 million shares. So mainly, they diluted almost 100% in the span of this 5 years. If we take from 2011, 56 million, 56, 55, 54, 54, 55, 57, they were pretty consistent. From 2011 until 2018, they didn't really do anything. When COVID hit, they started diluting. And as a company that doesn't want to take any debt, so the other option is to dilute. So I don't like it, but I can say if they would have had debt, they would have been paying tons of interest in meanwhile. So if we'll just take the numbers since 2011 until 2021, so that's a dilution of what, 55 to 75, what is it, 2.5% a year, something like that, not so bad. But the last year, when they went from 75 to 88, that's a huge dilution. I could say all these numbers, if you look in the 10Ks and 10Qs, it's a little bit different. In the report, in the bottom, it'll tell you how much the earnings per share was. It's a different kind of numbers. If you look at the top of the report, it'll tell you in the date of the report how much shares outstanding they had. That's usually the most accurate number. Not accurate, it's the most recent number. And So the question is, what happened to this huge dilution in the last year, a 20% dilution? Okay, so actually, once I figure out this whole acquisition and dilution, things pretty much settle down, and I figure it out more or less. So what happened the last year? You can see over here, this is the last 10K. Aquila acquisition. On December 10, 2021, the company acquired Aquila Resources. Basically, the way that they did this acquisition, they issued almost 14 million shares, 13.7 million shares for $24.5 million, and they gave these shares to the Aquila shareholders. And this is what they did. What did they buy? They bought for $29.1 million. They bought a stock consideration of $13.7 million, 13.7 million shares at $1.79 was $24 million plus $4.5 million cash. $29 million they bought Aquila. What did they get for that? So they got a project which is still in development. It's not even didn't get a permit yet, and they hope in 2026 to be operational, but we don't know yet how long it could take. You can never know. But basically, what they get: $95 million in assets. Out of those $95 million in assets, $90 million is property, plant, and mine development. The rest is peanuts. And out of the $66 million of liabilities, $42 million is gold and silver agreements. So first, let's get the part of dilution out. Basically, from 2006 to 2011, that was a big dilution. They were a junior company. From 2011 until COVID hit, they were pretty consistent, hardly any dilution. COVID hit, didn't want to take debt. They diluted the shares. They issued more shares to get more money. In the last year, they almost a 20% dilution. Wasn't a dilution, it was just acquisition of this new company. Now, we have to figure out exactly what is this asset of $90 million, how much is it really worth, and how much is this liability, and why is this a liability? So first we have to figure out what's this agreement. What's this gold stream agreement? So I'm not going to read the whole agreement, it's just no point. Basically, there was a company called Osisko who made an agreement with Aquila in 2017. They invested in Aquila. In the beginning it was $50 million. They didn't pay all the money yet. It comes in steps. Every time the company, the project, the Back 40 project goes into the next step, so they pay them more money. Basically, the last payment was like $42 million. And Osisko got for their investment in Aquila, which is now Gold Resource, they made an entire agreement, how much they'll be able to get all kind of gold and silver at different prices. There's a whole long agreement. But the question is, if this money was invested in Aquila, which is now Gold Resource, why is this a liability? If Gold Resource never has to pay it back, then why is it a liability? Just someone invested in the company. If the gold mine will be good, great, they'll get their investment back. If not, it's a bust. Why is this a liability? And another question we have to ask ourselves is, how much is the asset? This $90 million of assets, what is it really worth? Is it really $90 million or not? And this is pretty much a hard question to answer because I don't know. And this is totally out of my circle of competence. I just want to point out something which tells me that it's not as simple as it seems. So we can see over here, this is from the last 10K, the property, plant, and mine development. You can see over here the mine development, $92 million, and in the year before, $83 million. So there wasn't so much of a increase in the last year mine development. Where does the money come from? $80 million in minimal interest. The only thing that I know that happened in 2021, different than 2020, was the acquisition of Aquila. And over here, they're calling it minimal interest, $80 million. And when we go back to the acquisition, we can see that they made for the asset, they call it property, plant, and mine development, $90 million. Over here, there's nothing called, as they call it over here, over here, they call it minimal interest. So if this minimal interest is the mine that they bought, then why did it go down in $10 million? So I don't know. I don't have an answer for all these questions. I don't know. But all I know is that for some reason, the mine, which they listed as $90 million, for now, for some reason, it seems to be called minimal interest at $80 million. I don't know. Maybe they decided to, I don't know. I don't know the answer to this. But all I know is it's not so simple to just say it's worth $90 million. It's not that simple. So going back to the question about the liability. Why is it called a liability? So I tried for an entire week to call management, and this is a small company. They don't even have investors relations. And then after a few times I tried to reach management, they told me to send the email and someone will answer me. So basically, I asked a simple question: does Gold Research need to pay back the $42 million, now it's already 43, to Osisko if the Back 40 project doesn't get a permit? So this is what they answered me. Technically, a default event would trigger repayment. So if Gold Resource, they have a subsidiary that bought Aquila, if they default, then they have to repay the 40, whatever it is, $43 million. However, typically what would occur in a stream agreement scenario is the asset, which is Back 40, would be transferred to Osisko in lieu of repayment. So it's an interesting, it's a liability, because in GAAP accounting, it's a liability. Because if an event of a default, they have to give back the money. But it's not exactly liability that the company has to pay back. Only if Gold Research does something bad, they don't do their agreement. I don't know. They don't try to get a permit, whatever. Then they have to pay back, or if there's a default. But if everything goes without Gold Research doing anything in bad, then they don't really have to pay back this money. And even if the project does not get a permit, or it's a bust, they won't have to pay back the $42 million. They'll just give back Osisko the project. So if we take off from the liabilities the $42 million, we're actually getting a book value much, much higher. We're getting the 200. How much did it come out? We have over here the $200 million in assets, and we're basically taking off $43 million of liabilities into 88 million shares. We're adding on almost $0.50 of book value. If we're not going to consider this agreement as a liability, then we're adding on $43 million to 88 million shares, which is more or less another $0.50. So the book value isn't $1.30, it's more like $1.80. And that's already something totally different. But on the other hand, we can ask ourselves, is this asset a true asset? So I asked this question also to the management. I asked them, if the Back 40 project turns out to be a bust, will these $90 million get totally impaired off the balance sheet, or will there still be some value left over, even in the scenario that the mine is a bust? So this is what they answered me. Depends on the scenario and the agreement we would reach with Osisko. If there was a full impairment of the assets and liabilities would be net together, and the impact would be $35 million. So I didn't get a straight answer, but basically what it seems to me, if $90 million was invested in a mine, and the mine is a bust, then what's it worth? What are you going to do with all the construction that was done over there? The mine isn't worth anything. The buildings, the machinery, I don't know. It probably makes sense if things go bad, then the $90 million will get impaired somehow, and the $43 million liabilities will get impaired. So we're basically trading off the asset and the liabilities. So that's a big thing. If we take off $90 million from the $200 million, and we're taking off $43 million, we're getting here about $45 million, taking off from the book value. So instead of $1.30, we're getting now 80 cents of a book value. So it's very hard to know the exact true value of the book value. I don't know. It's out of my circle of competence. But let's assume that everything goes good and the company is getting a project. They don't have to pay back the liability if the company doesn't do anything bad. If the mine is good, they'll be paying back the liability by all the agreement that they have, and they're getting a beautiful asset. So the question is, what's a timeline? What's a timeline to the project? And so what he answered me, we plan to submit permits upon successful completion and filing of the feasible study. That's what he wrote in the second half of 2022. After this application submission, the permit process may take a year or longer, depending if there is a contested case hearing. So over here in their presentation, it seems that they think in 2026 they'll start getting from the Back 40. See, Back 40 estimates, we have 2026. So they're estimating another 4 years until it'll start becoming operational and earning money from it. So again, let's just make a small conclusion what's going on over here. So we have here a pretty young company that's trading at a pretty cheap price. Their past 10 years has been pretty good. They've been earning money every single year. Their operating cash flows is positive every single year. Their free cash flow was mostly positive almost every single year. And they're expanding. They have an operational mine in Mexico, which even that has still tons of properties, which they didn't even start exploring. Now they bought another property, which is investing tons of money in, which is making their income statement look bad. We have here a book value, official book value of $1.30, and a stock that's trading at 89 cents. And actually, there's a liability of $42 million, which isn't a real liability. This liability is not something the company has to pay back unless they do something bad, in bad faith. If they don't do anything bad, then they're not going to pay back. It's just going to be taken off if, let's say, the mine is a bust. They take off deduct this $42 million liabilities, and then deduct the assets, whatever it's going to be worth whenever something's going to happen. So if we're looking at it as a company that has a balance sheet of assets of $250 million, lately it was even lower in the last 10Q, and a liability of $45 million, the company looks to be in a good structure, and it's earning money for the past 10 years. It seems interesting. I don't know. This is out of my circle of competence, but it seems like an interesting company. Now, just another shout out. I just did the gold resource, but you can also check out SSRM. That's a symbol. It looks also like a very interesting mining company trading under book value. But for now, I had enough of analyzing gold mines. Thank you very much, and I hope you enjoyed this video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.